Hey guys, got a jumbo video today of moves I'm making in the portfolio. Everyone who's been coming along, this is day 3 and just starting out on tracking the financial independence journey and looking at how we're going to make it to 2 million. I want to talk about the moves that I'm making out there. I bought a lot today, over $300,000 in the portfolio, and why I'm making a major shift in my portfolio. So I want to get into that right now. So let's go ahead and jump into it. And the first things first. So as you can see, I have made over $300,000 of buys today and put orders in that are going to hit tomorrow. And first thing is, how did I build money to this point? So it didn't happen overnight. I've been investing since 2009, but I've been investing primarily in large cap growth companies, and they've done really, really well. The companies like Microsoft and Apple, Nvidia, basically the Magnificent Seven. I've gotten some great gains over that time. And why I'm changing now, I'm noticing a shift. And basically what's going on out there is there's always rotations in the market. There's always there's short-term and cyclical, and then there's long-term changes. And I'm still long-term bullish, large cap growth and the Magnificent Seven. But what I'm doing now, I've gotten to a point where my portfolio needs a little bit more diversification because of where my time horizon is in my late 30s. So now that I've built up this portfolio, I want to start the shift not to all automatically to preservation of wealth or just dividend income. I'm not there yet. I'm in the second phase of accumulation. And so what that means is broadening out the portfolio into the market. And the second part of the adjustment is I want to have a little bit more exposure, particularly to the second tier companies that are the AI, semiconductor space. And so there's something that caught my attention of what's happening. Semiconductors this year up 107%. The Mag 7 names are down 8%. So Mag 7, that's kind of the large cap growth funds are made up really of like the Mag 7, give or take. But then you have these semiconductors that are killing it, like MU, AMD. And it's just really mind-boggling of what's happening, because the Mag 7 is spending as hyperscalers to fund the sort of what's called picks and shovels, the second tier companies. And so it's really interesting to see this play out. So what I'm doing in the portfolio is I'm moving more of broad-based core S&P 500 index, so 50%, approximately 47%, and then just getting the whole total market, 22%. And then instead of being about 70% large cap growth, which I was previously, I'm dialing that way back to like 8 to 10%. And then adding a little bit into semiconductors, about 7%, $25,000. And then a little bit of international for diversification, $20,000. And then I'm overlapping the Fidelity Index funds, which most of these index funds or mutual funds they're actively managed. I'm also buying into Vanguard ETFs, which are more passive and have lower expense ratios. I like to have, both the Vanguard and Fidelity. And I'm also adding a little bit of SMH to fit my thesis for semiconductors. So overall, in sum, I'm doing two things. I'm pulling back from being heavily overweight on large cap growth. Like I'm talking 70%, hundreds of thousands of dollars in large cap growth. I'm mostly putting the core now in the S&P 500 broad market index. That's going to be my core, my heavy lifting, get more diversification. So basically, if the US stock market does well, the portfolio will do well. And I'm very happy with that. And then adding some semiconductors, because I think with the AI super cycle, I'm pretty sure that AI is going to be here for the foreseeable future. And yes, there may be a rotation out of semiconductors and a pullback, and that's why I'm only going 70% or 7%. I'm not going all in. And so that is what I'm doing today in the portfolio. Got a little bit of some smaller, QQQ allocations, mid-cap, very small, emerging markets, and SCHD. And you might say, well, why aren't you getting more in dividends? Because, growth dividends is a great way to build up the portfolio. And I would agree with that, but I'm still in the second phase of the accumulation phase. I'm not quite ready to go heavy on dividends. I still want to have that alpha and growth and also that broad market diversification. So overall, about 74.5% in the U.S. broad market, very diversified, some of the best funds out there, very low expense ratio, and anyone could be buying into these, not financial advice. And then dialing back growth, like large cap growth, from 70% down to about 10%, and then adding exposure to the semiconductors, which I really didn't have before, with some semiconductor mutual fund index funds and ETFs. And then, of course, international for diversification and a little bit of small cap and dividend value. So that is what I'm doing in the portfolio, and I'm pretty happy about it. The pros, over the last decade or more, I've done really well in large cap growth. In 2022, we had a big sell-off in large cap growth, and it took us several years for some of the funds to recover. And if we do have a big sell-off again, being in my late 30s, I don't know if I want to be that overweight large cap growth, and especially with a lot of the mega caps just not getting the love. I want to see how this plays out and just flatten out my diversification across the whole market. So that way, and I do believe in my AI thesis that AI is going to hit financials, industrials, energy. It's going to go across all the market, and it's not just going to be in the semiconductor. And I think that's going to be the next phase of it in 2027, 2028. So with that, I'm going to be getting exposure in these indexes across the whole market and benefit from the AI supercycle. So that is what I'm doing, and I feel like this is better risk management. I feel like that if we do have a big downturn like we did in 2022 because of inflation, if the Fed gets super hawkish over the next couple months with interest rate increases, I'm not going to be subject to a huge, as much of a dent being, almost all in on large cap growth. And I'm going to have, an easier recovery and better risk management for being across the market, the broad market index and S&P 500. There's reasons why I like ETFs and mutual funds. The ETFs are a little lighter weight, lower cost expense ratio, but these are long-term accounts. So the mutual funds, index funds make sense as well. And I like both companies. I think that they're both good, Fidelity and Vanguard, some of the best, the best products that they offer in the world. And so this to me is simplifying it. It's diversifying the portfolio. And it just makes the most sense. So recapping, that's what it looks like. 74.5% broad market, Fidelity and Vanguard funds, index funds, mutual funds, ETFs, growth, but also getting another 10% or so in semiconductors specifically, which I didn't have before, international, and then small cap, mid cap, and a little bit of dividend value. So that's how we're splitting up this move today, and I'm gonna plan on tweaking out things a little bit over the next few weeks, but this is essentially how we're going to be moving forward. So just, high level net worth 1.45 million. And it did have, it's on the chart there. The reason for the downtick is because I was moving funds around in the accounts. And so it took a while for those to settle and pick up over a couple of days. So that's how it's set up. And then the overall net worth is about 850, 900,000, like 63%, 2/3 of my net worth is in the stock market, right? In the retirement accounts. And then about, 450, 500, depending on how the market is with housing, 1/3 is essentially in my house equity, which is paid off. And then the rest is in 6 months emergency fund and a high yield savings account money market, and then a taxable brokerage. And this is the one, the numbers there at 53,000, a taxable brokerage. I'm buying individual stocks and I'm buying growth companies, dividend growth. I have commodities and precious metals. I'm building up a portfolio that I'm going to build out in the brokerage account. And that the number of 3.8%, I'm going to see that tick up. That's going to be more like 5 to 7% over the next couple of years, and build up the brokerage account into 6 figures and then a long term, eventually seven figures, and then 529 for kids' college, HSA, investing in the HSA, getting tax benefit, and just a little bit in a Bitcoin. I know we've had a 50% drop in Bitcoin, but that didn't really hurt me too much because some people are like, oh, 10% of your portfolio in Bitcoin. That was not me. I'm more like, let's keep it at 1%, no more than 3%, because I still view it as a speculative asset. I'm bullish on Bitcoin long term. I think it's going to do well after several halving cycles. We're going to be back, in the hundreds of thousands of Bitcoin. But in terms of the fluctuations and the volatility, just to stomach it, I don't like having a huge percentage of my portfolio in Bitcoin. And then just some vehicles and a little bit of just, consumer credit card, just paying that off every month. But in terms of things switching gears now to macro, some of you who followed the account or listened to some of the videos, I like macro. And I just want to keep an idea of what's going on there and appreciate you all being here. The housing market is really at a point now where the sellers now outnumber the buyers by 630,000. It's the largest gap ever. The housing market's just been really jacked up since all of the printing, since the lowering the interest rates and raising them. And I mean, it's just really interesting. A lot of the boomers with all the real estate, they're like, oh, we don't want to lose value. We paid $50 for this house in 1980 and now it's worth, 5 million, just kind of exaggerating a little bit. And it's gone down $1 million. So it's really interesting. And then you have people who are coming out of college, they can't afford a house. The 25, 30 can't afford a house, 35 can't afford a house, and it's just crazy. The other thing that's really interesting is the mega caps. The Mag 7 has just really not done well. Companies that are paying for the super cycle, that are paying for all of the investment in AI, the hundreds of billions of dollars in investment, they're just getting crushed, which is just not making a ton of sense, except for the reason why is because of the cycle we're in. It's simply because markets, the big banks, the big whales, there's momentum trades, and there's also a lot of margin in the market right now that's really frothy, and there's a lot of there's a lot of just kind of casinoing going on with whatever's hot. And right now that's just the semiconductor space with all the AI chips and so on. But in the meantime, like the Metas, the Microsofts, they've been getting destroyed, even though these are cash flowing giants that are going to be around for decades. One person said if you started investing, the best plan is to go on the S&P and ignore everything else. But what about buying or holding a stock? And the S&P's outperformed the Mag 7. The S&P 500 has outperformed the total Mag 7 over the last couple of years. But that's because of basically three, the Microsoft, Meta, and Apple have underperformed, and Tesla as well. But if you just held, like, for example, NVIDIA has gotten a little haircut recently, but NVIDIA has done really well over the last couple of years. And so has Google, and Amazon hasn't done bad either. So for me, the answer is both. Own both. MU had extremely, just wonderful results yesterday in their quarterly reporting. And I thought this was pretty funny because if you sold before the earnings yesterday, that hurts because they're up 15% today, which I talked about this 2 weeks ago. I said if MU, if they're reporting, if their earnings does well, we're going to continue to see more money inflow into the semiconductor space, and we're going to rally up, and we're going to rip up even more. But if MU underperforms earnings or there's any negativity around their earnings with AI, then we're going to rip back down. And so that's exactly what we're seeing, the rip up because the earnings went well. Also, for those who are interested, Nancy Pelosi, she's buying Intel and Uber calls. I don't understand how Congress can still be doing this. It's just unbelievable how this still goes on because of the insider trading that takes place. It's just unbelievable to me. You can work for the government and you can't do this, but if you're a senator or congressman, you can. It's the haves and the have-nots. And then also just thinking about the people out there, like we've had some pretty major earthquakes in the last day. So praying for those who've been impacted by that. pretty incredible tectonic plate shifts that are happening. Something to keep an eye on, which could, in the markets don't have to open up tomorrow. We can have black swan events, and it's just something to keep an eye on when you have things like this. But more importantly, the people involved and anyone who got hurt. This is just more of the memory funders. I've just seen this today. People are picking up on it. The companies, which the Mag 7 that are funding the AI boom, they're all down, but the memory chips are going to the moon. Unfortunately, console storage and memory prices have increased by more than 2.5x, and we expect another doubling by the fall of 2027. This is from Microsoft. Part of the reason why these memory second-tier companies like MU and AMD have gone to the moon is because of supply chain and inflation of the memory chip prices, the bottlenecks. But when these release, it will whiplash back down like a rubber band. So something to keep track of. And right now with all of the hype, when you go parabolic with a company like MU, I'm really, really careful to be buying at these levels. And so that's why I prefer the index over the individual stock. But when I do buy the individual stock, it's dollar cost average so that you don't get crushed. But anyways, folks, just wanted to mention the moves from today. And if you like this content, feel free to follow along the journey. We're going to be tracking this, just trying to get to the goal of 2 million, explain tips along the way, and see how the market performs and reach this journey. So appreciate all you folks out there who are able to tag along with us and be a part of it. Thanks so much.